Welcome, and thank you for joining us for today's webinar on charitable giving strategies for the new year. My name is Sandy Adams, and I am a lead financial planner and partner here at the Center for Financial Planning. I'm honored to be joined today by Jana McNair, Director of Philanthropy at Wayne State University. Welcome, Jana, and thank you so much for being here.
Thank you, Sandy, for having me. I'm delighted to be here. I'm the Director of Philanthropy at Wayne State University, which means I get the wonderful privilege and pleasure of matching up donors and their philanthropic goals with the university's needs every day. And it's a wonderful privilege, and I'm excited to be here today to talk about that.
Awesome. Jana and I, just to give you a little bit of background about why we're here together, we've been working together over the last almost year, I think, on an endowment fund for the Institute of Gerontology at Wayne State, which many of you may know that I personally and the center have supported for years. And through that work, we found some great synergy, which has resulted in us bringing you some valuable information today about charitable giving, planning for that giving, and doing it tax efficiently, especially in light of recent tax legislation changes. I thought that we would start today by letting Jana talk a little bit about why she sees people giving, planned giving in general, and some of the most common ways people give based on her experience at Wayne State. And before I let her get started, I'm just going to side note, as a reminder, we still cannot take questions during the presentation today, but please do not hesitate to email questions to either of us. Our contact information is at the end of the presentation, or your planner here at the center, and we'll make sure that we get back to you with answers to your questions. With that, I will hand the mic over to Jana.
Thanks, Sandy. As you mentioned, I do get the wonderful opportunity to talk to donors about giving. And what I see most often is that people don't necessarily often know the different ways that they can make a gift. And people who are philanthropic and driven to give, which is most people, tend to give in traditional ways. They may write a check, give a cash or credit card gift here or there, and not really know the way that they can make a more impactful gift and the benefits of planning your charitable giving in a thoughtful way. And what we see when we sit down and have conversations with donors is, first of all, obviously we always want to listen, and we want to know what their goals are and what they're looking to do and what kind of impact they want to have. What is it about that particular organization that resonates with them? In your case, it's gerontology and research around gerontology. And any organization that you're giving to is going to have a mission and different areas they want to support. And after listening to that, I can share with them what the organization's needs and priorities are. And it really sets the table for a conversation between myself, the donor, and their financial planner about how to talk about making a gift that would have a significantly larger impact than they would otherwise be able to give. A lot of times this will come up over the years. We have a donor who's given, every month or every year for 50 years, and they say that they want to do more and they just can't. And you learn through conversations that there are a lot of different ways they can do that. And one of the most common that we see is just a straight bequest through a will or a trust, where people may designate a certain dollar amount or percentage of their estate. And that is an amazing legacy gift that we see happen a lot. And it's a wonderful way for a donor who doesn't have a lot of assets that they can give away right now to make a larger contribution in the future and be able to be celebrated and recognized by the institution now. So by documenting that planned gift with the organization, it allows the organization to celebrate the gift with them now. And it also allows a donor who loyally supports a cause to know that they're giving beyond their death, that they can give in perpetuity and support that institution even when they're gone. Another thing that we see often is a blend of those things. So if it's not a straight bequest through a will or a trust, we have people who will give beneficiaries is another common one, listing the organization as a beneficiary on a retirement account for a certain percentage or dollar amount. that's a great way. We see that a lot at the university, where people will look at their retirement accounts and say, oh, I have significant assets here. This is a great place for me to list the charity that I'm interested in as a beneficiary. I would say those are the two most common sorts of plan gifts. But again, and I know you're going to talk about this later, planning for what makes the most sense is so important. A gift that may have a combination of different ways to give could allow a donor, again, to give more than they could have ever thought. And those transformational gifts, I have the benefit of seeing, and we want the donor to be able to see the impact of that gift.
Absolutely.
Another type of gift that we see come in is a IRA rollover gift. So these would be gifts that people would make, and to talk. Another type of gift that we see common is an IRA rollover gift. In my experience, one of the most rewarding things I've seen is that somebody who may have to take a distribution will do an IRA rollover gift, which again is a significantly larger gift than they normally would be able to give. And they'll make that gift and see the benefit and impact of making that gift. And it can lead to additional giving through a will or a trust. And it's a way that a donor can also really begin to understand how their organization can utilize their donations for the greatest impact, and they can be involved in that and see that giving happen. I have an example of a wonderful couple who did an IRA rollover, and they had just always wanted to give back and to scholarship and research. And it was a donor who had been given full ride scholarships and support in her life and felt that it was the thing that made a difference for her, and she wanted to give back. And throughout her life, she never had the opportunity to give a gift large enough to, say, establish a full scholarship. And so when we sat down, she said, she was over 70 and a half, and it made sense. And her financial planner said, you could do this type of gift. And she did an IRA rollover gift. And after 2 years of us awarding scholarships, she was so delighted at seeing the impact of that she then established an additional plan gift through her will or estate to increase the amount of that scholarship and research fund that she established. And that's one of those things where you really see how that makes a difference, not just for the organization, but for the donor. It brought her great joy, and I'm sure financially she benefited from it in some way as well. It made sense for her and her husband. And I think the marriage of those two things, I think, is what's so wonderful about gift planning.
Absolutely. Wonderful story.
So another type of giving that we see, and we can talk a little bit more about it later, are income gifts. And I'm sure, Sandy, you can speak, and we always sort of say when we're talking to donors about income gifts to make sure that they're consulting with their financial planners about what these would be, and they make sense in certain situations. And these would be a type of gift where you could support an organization and also receive income.
Sure.
And that can be a significant benefit to certain types of donors. Another thing that's not necessarily through an estate, but with doing appreciated stock giving, is being able to get certain tax benefits by making a gift through securities. And you can do different things with that. So in addition to setting up potentially a research fund or a scholarship at the university, a donor may want to establish a major or larger gift to memorialize or tribute someone. So I have an example of a wonderful donor who used stock to set up an endowment fund in memory of her father, who was pivotal in her receiving an education. And that established fund now exists in perpetuity in memory of her father, and she was able to establish that through a gift of securities.
And I know we have some additional plan giving information, so if you think of some additional items, we can cover that at the end. One of the things that I wanted to move on to next was talking a little bit about some of the issues that we talk to clients about as we're meeting with clients on an annual basis about their giving and giving from a tax efficient standpoint, especially in light of the Tax Cuts and Jobs Act. So we've had a year of this, and there have been some recent changes related to how people can give and how they can give on a tax efficient basis. And what does that mean exactly? So some of you have figured a little bit of this out after having been through this for a year. But if you've been in the office and met with us, we've probably had this conversation. But many of you know that the standard deduction is much higher these days, and fewer of you will be itemizing your deductions. Itemizing your deductions is where you got credit for your charitable contributions. So that means for those of you who have been giving charitably and using those charitable contributions to itemize on your itemized deductions, fewer of you will be able to get credit for those charitable contributions. So here's an example. Before the Tax Cuts and Jobs Act, the standard deductions were listed here. For a single person, you got a standard deduction of $6,350. That same standard deduction is now $12,000, meaning you have to have more than $12,000 in itemized deduction to get to actually use those itemized deductions, to beat that standard deduction. Meaning, if you're, charitably giving, you won't get credit for those charitable contributions unless you can beat, those total itemized deductions is more than that $12,000. If you're a married couple, it's an even higher bar to beat, $24,000. And if you're over age 65, you're each getting an additional $1,300 added on to that standard deduction. So it's a pretty high bar to beat. In addition, the itemized deductions are somewhat limited. For instance, there's a $10,000 cap on state and local taxes. So that kind of line item on your itemized deduction, for many folks, that line item was more than $10,000, and now you're limited there. So for some people, that line item might have been $15,000 or $17,000. It's limited to 10, which even further reduces the number of people that might be using the itemized deduction. And there are no miscellaneous itemized deductions allowed anymore. So people who were writing off professional fees and things like that can't use those anymore. So the end all be all is fewer people are itemizing, fewer people are getting credit for charitable giving. And probably, unfortunately, for most institutions, churches, and other nonprofits, probably that's limiting the number of people who are giving. Because as I like to say, it would be nice if people were all just giving out of the kindness of their heart. But unfortunately, I think a lot of people also give because they're getting a tax write-off. And that's limiting the number of people who are giving. So what we need to do is plan ahead. And that's what we're here to talk about today. So we can still get a tax benefit from contributing charitably. And what are the three most popular ways we can do that? Number one, we can donate appreciated securities. We're assuming here that we could, if you donate appreciated securities, that you're probably planning on being able to itemize. So again, we need to plan ahead and plan to give enough to be able to itemize in that instance. So we're planning ahead in being able to give enough in that particular year that we would be able to itemize, and either give in a big lump sum, give enough in 1 year, like that second line item, lumping, maybe giving in 1 year enough for 2 years, or lumping contributions to a donor advised fund, number two. And then number three, taking advantage of something Jana kind of referred to, qualified charitable distributions, is a way for those over age 70 and a half that are under the required distribution rules to be able to give directly to charity from an IRA. So those are the three things we're going to be able to talk about today. Again, it's more important than ever to plan ahead for your giving. Why do I say that's important? There are a lot of folks that give and have given so nonchalantly that planning ahead didn't matter in previous years. For instance, how many folks out there give to church or give to a charity on a regular basis, on a weekly or monthly basis, and don't even think about that? Where now it probably makes more sense in a lot of cases to lump those contributions into one lump sum, either in one time a year or maybe one time every 2 years, in order to take advantage of a deduction somehow, right? Mm-hmm. To get a tax write-off for that contribution. So planning ahead makes a lot of sense. And unfortunately, that probably means you might not be able to put the check or the cash in the basket unless you don't want to get the tax deduction. But it makes a lot of sense to plan ahead. Again, if you're using the required minimum distribution, qualified charitable distribution, some people have automatic payments set up. And if you're planning on using that type of qualified charitable distribution, you need to plan ahead for how you're going to do that so that you don't mess up those automatic payments or miss your opportunity to use those. So working with your planner and planning ahead is imperative in order to use these properly.
And I think, as you said, it's more important now than even before with the new itemization to think about your giving in a different way.
Yeah. And I think a lot of people missed opportunities in the first year of the tax reform because they weren't as aware of the changes until maybe mid-year or towards the end of the year. So this is almost our first opportunity to really plan ahead at the beginning of the year. So donating appreciated securities, maybe most of you are aware of this, but it's always a good reminder. I can't tell you how many times I've had a conversation with a client, and I know we've talked about it before, and they seem to have an aha, so it's probably a good conversation to have again. How does this work? So a lot of people just continue to give cash and take that cash out of your income flow, and you give it right out. So you're taking from money that you have at the bank or money you have coming in from income, and you give it out to a charity. You can deduct that just like you would deduct any other type of charitable giving. Or you can give appreciated securities. So you can give stock or a mutual fund or a bond that you bought years ago and that has grown in value, and take that in whole and give it to a charity just the same and get the same tax deduction. How does that work? This is an example. Cindy wants to donate $20,000 to her favorite charity. In this case, she owns Apple. We're going to say this is Apple before it dropped recently. She owns 100 shares worth $20,000, $200 per share. And if she just sold it straight out to get the cash, she would owe capital gains tax on the appreciation, right? So here, if she sold the Apple shares, she bought it for $2,000. Its current value is $20,000. The capital gains $18,000. She would owe, $2,700 in tax on it. So, she's losing a little bit of buying power on that by selling. Instead, if she were to just give the stock itself, she still gets $20,000 to write off as a charitable deduction. And she doesn't have to pay the $2,700 in stock. And in addition, she's getting credit for the charitable deduction. And as an extra bonus, the charity does not pay capital gains tax either, because there's an IRS rule that says 501c3 organizations do not pay capital gains tax. So it's a win-win, except for the IRS, and I don't think there's anyone here that would care that the IRS was the loser, right? So we always say that's the bonus.
And this is a great example, Sandy, of how, say, $20,000 is $15,000 in value. And if a lot of times you ask a donor to really sit down and add up every time they replied to an email and gave, or give to their regular charities. And, when they do sit down and look at what they're giving at the end of the year that they didn't even plan for, you can think about a scenario like this, if they have those assets, to say this makes more sense for your giving.
And it also, when they think about the fact that it also frees up their cash flow.
Exactly.
Right? Instead of taking, $20,000 out of their cash flow that they might be taking out, and it doesn't touch that. That makes a big difference to a lot of folks.
Yes,
as well. So generally, in this, this is example number 2. This is Cindy again. Generally, she's giving $1,000 a month to her church, so $12,000. That is costing her generally about $9,000 out of pocket. Because she's in the 25% tax bracket, right? We're talking itemized deductions in here. In 2018, she can't itemize deductions, she finds, because she doesn't have enough in itemized deductions. She's going to take the standard deduction. So unfortunately, she's in a position where she still decides she wants to give to her church. She's not going to stop, but it's going to cost her more because she's not going to be able to itemize. So what we're recommending that she do is lump 2 years of giving to her church. So take $24,000 and put it in what we call a donor advised fund. And then set up a payment of $1,000 a month to her church from the donor advised fund. If we've never talked to you about a donor advised fund, or you've never heard of that, what is a donor advised fund? A donor advised fund is an account or program. It can be sponsored by a public charity, or in our instance, it's Raymond James has one. There are other broker dealers that have them as well, and mutual fund companies. They will set those accounts up in your name. You're still in charge of the money, but it's set up as an account specifically for giving. So once it's in that account, it's an irrevocable gifting account, charitable account. So the money's in there. You get a charitable deduction in the year that you gift, either the cash or an appreciated security, so double bonus, into that account. And then in future years, you don't get a second charitable deduction for gifting out of it. But so you gift money or securities into the account, charitable deduction in that year. And then in future years, you can choose to gift out of that at your disposal. There's no limit on when and if. Sometimes there are limits on how much you can gift out of it, usually a lower limit. So you must gift at least X amount out of it to a particular charity. Like at Raymond James, it's at least $250 and not less than that. But some of them have lower limits. And you can set up automatic gifts. You can set up a bequest at the end if there's money left in the account at the end. This is the charity or charities the monies go to, but you're in complete control over where the money goes to, and you can set up multiple ways to go to. So, and you can set it up so that you and or multiple people in your family are the advisors to the charitable fund. So very flexible, and it allows you to make these what we call lumping or advance gifts into the account so that they can be more tax efficient. Mm-hmm. And we usually recommend that you're using appreciated securities to kind of accelerate the tax efficiency of the contributions.
That makes sense. Mm-hmm.
So in this case, the tax benefit to Cindy for lumping multiple year donations in a single year gets her over the standard deduction hurdle. The $24,000 contribution costs her $18,240 out of pocket because she saves $5,760 in her 24% tax bracket, and also removes capital gains tax because she used a security that had capital gains tax, and it was appreciated securities.
And then that $24,000 also earns.
Right. And then in those donor advised funds, what they generally do, if you donate an appreciated security, they will likely sell that appreciated security and invest it according to your wishes, and you'll have multiple choices on how you'd like the money invested, very conservatively to very aggressive, depending on your choices. But it's also a way to divest of a security that you might have that's was inherited, or you got from stock options in your company portfolio, or something that you otherwise may not have sold because of the capital gains implications.
Right.
So that's another planning opportunity as well. Now moving on to the qualified charitable distribution, which is one of our actually most popular choices in this last year for folks over age 70 and a half in that required minimum distribution status. And it actually does not have any, it doesn't matter what tax bracket you're in. Mm-hmm. Doesn't matter if you'll be itemizing or not itemizing. So this is really an above the line, we call it an above the line quote unquote deduction. What this generally does is removes any distribution you're taking from your IRA from being taxed, because the distribution goes directly from your IRA, and it has to be an IRA. It can't be a 401k. Under the IRS ruling, it has to be an IRA account. Takes the distribution directly from an IRA to a 501c3 organization of your choice and removes it from being taxed. So I will kind of put a asterisk on this. Just if you're doing this, please be aware that currently there is no special tax code for these distributions. So when you receive a 1099, it will be reported as any other distribution. So you have to be very careful to make sure your CPA is aware that you've done a qualified charitable distribution so that they report it properly. So we're being careful to provide documentation to our clients so that they can provide that to their CPAs, and we're also trying to educate CPAs the same way because we've seen some misreported. Mm-hmm. We're hoping that the IRS does create a new code for that, but currently there is not one. But how this works is there is a special distribution form that is required, and you fill it out so that a certain dollar amount goes, and the check will go directly to the charity from your account, not to you. Mm-hmm. Although it can go to you, but it has to be made out to the charity. We found that out because we were having trouble with some checks getting to some places. So if a client prefers, it can go to them.
We actually recommend to our donors to send, and we even provide a form letter that they send both to the organization and to the firm so that everybody's aware, and the charity can anticipate and expect that gift and know to look for it, just to avoid any.
And we try to follow up with the organizations too to make sure that they got them.
Yes, this is also a very popular option for us, particularly recently, in allowing donors to be able to, again, make major gifts that they, motivating them to make major gifts that they maybe didn't think that they could make.
So this is an example. In this case, we have Dorothy, who's Cindy's mom, keeping with the consistency here. Dorothy has a $500,000 IRA. She's required to withdraw $25,000 from her IRA in 2018. That's the calculation. We always get the question, why are there mandatory withdrawals? Because it's an IRS rule. They want their tax revenue at some point. So at 70 and a half, you have to start taking withdrawals. I got the question yesterday, will I have to take them? Do they stop at any point? No, not until you pass away, and then your beneficiary has to start taking them. So yeah, once they start, they don't stop. All withdrawals are treated as taxable income unless you use the charitable distributions. Those are not taxable. Nor the required distributions normally would cost Dorothy $6,000 in taxes. Even though she doesn't need the money, she still has to take the distribution and she still gets taxed on them. So just to kind of give you a breakdown of what we call them, QCDs, of course, because we have all kinds of acronyms, right? So if we say QCD, that's what that means. Is a tax redistribution from the IRA when the funds are sent directly to the public charity. Again, they can't come from a 401k. So if you've left your money in a 401k at your former employer, might be a reason to roll that over into an IRA so that you can utilize the QCD. An IRA account holder who is 70 and a half or older can use them. So not that we want to get older by any means, but once you reach that age, you can start taking those, using those. And you can take more than your required minimum distribution, which is probably, to your point, some people that are doing those larger gifts. So even though Dorothy's calculation for her required minimum distribution was only $25,000, she can do up to that $25,000 if she only wants to utilize her required distribution, and all of that could go to charity. But she could do more if she wanted to. So if her plan, she worked with her planner, and her planner said, you know what, Dorothy, you could do up to $100,000 to a charity and your plan works out just fine. She could actually give up to $100,000 directly from her IRA to any charity in any 1 year, and that would work fine. And she would be within the IRS rules. So, and that's still the rule for that. I don't see that changing at any point. But and that would reduce her adjusted gross income for the year.
Yes, I've seen that as something that donors have used also to do that and to get into to reduce their AGI.
Yep. I haven't seen many people actually doing more, but I have had a lot of clients actually doing their full required distribution indirectly too.
It's a great vehicle as part of that overall conversation when I'm talking to a donor about what they really want to do. You know, if money wasn't an object, what kind of a gift would you want to make, or what kind of impact would you want to have? And just having all those different options really allows you to lay that out.
So in this case, Dorothy decided to send her entire $25,000 distribution directly to her church. She paid $0 in tax on that distribution. So in that 24% tax bracket, she would have normally paid $6,000 in tax. She saves $6,000 in tax. So that's kind of the end of our three major strategies that we're using with clients on a kind of annual basis. Kind of going back to the plan giving area where Jana kind of lives and breathes. Many of the clients she's dealing with are wishing to leave a gift to a charitable organization through kind of an estate or as a legacy. And kind of going back to some of those strategies. We talked about kind of in a will or trust, so working with an attorney to do that.
Yeah, and when I talk to donors about making a legacy gift and what that might look like, it's the marriage of the intent of somebody to do something that, for example, at Wayne State University, we can establish an endowment fund, which would exist in perpetuity. And so if a donor is interested in that, say a scholarship or a research fund, and those are oftentimes motivated by experiences and emotion and influence. If it's a university situation, perhaps it was a scholarship, or it's in the example of the Institute of Gerontology, we have a donor who established a state gift to set up an endowment account, and that's a named fund, and that honors her name for as long as the university is in existence, and that initial gift after her passing is invested, and the interest on that is what is distributed for the organization or for the Institute of Gerontology to use every year for whatever the donor has designated. It's a great way for, in particular, this donor who supports the mission of that particular area of the university, and then also can specify, I really like this particular area of that organization. So is it research? Is it gerontology research? Is it community outreach and programming? And they can say it's an opportunity for them to tell their story, to tell why they give, and then know that those funds are being generated as long as that institution exists. And I think that as a fundraiser is where I sort of live and start, and then being able to utilize all these different giving tools to kind of get the biggest impact for everybody involved, I think is where that planning piece becomes so important, because the legacy is really what's driving it, that emotion that they have in wanting to make that gift and leave that legacy. And a lot of times, that it may be, as I mentioned earlier, in honor or in memory of someone. Is it a parent? Is it someone who influenced their life? There's so many examples of, particularly in higher education, of, first generation to go to college, and their parents and grandparents supporting them, and sort of honoring that family and establishing that really goes a long way. And of course, a larger gift that's invested, that's going to create funding for that organization forever, is a wonderful thing for that organization. But we most commonly see giving through a will or trust directly, or as I mentioned, as you have here, and I mentioned earlier, beneficiary designations is a large one. And to speak to the generation story, I have a wonderful example of a woman who was an alum and graduated as a single mom with 5 kids, and education was very important in their family, and she knew she wanted to get an education, but she couldn't afford it, and got scholarships, and kind of at the end of her career after retirement, scrounged together, enough. And at the time was when she established the gift, was like, this is everything that I can give, and I want to give it to set up a scholarship. And then years later, after her passing, her children have now, through beneficiary designations, all designated through their retirement accounts for a gift to go into their mother's name scholarship, which will grow the scholarship, which is being invested, and create more money for students to honor the memory of their mother. And it started with, one son sort of deciding to do it, and then all the other kids sort of sat down and were like, what could we do? And I see that a lot. I see sort of generations doing that, and it's wonderful. And the different ways that they're able to do. Some are able to give cash, some are doing it through planned giving vehicles.
How often these days do you see people using some of the income gifts, like charitable gift annuities, just with the just people living longer, and how many people are willing to commit to, setting aside assets, knowing that they may need them for their own
Yes.
long-term care and
Yes. From a fundraising perspective, we for any kind of legacy gift. So we would say it's an estimate. And I've had donors say, "Oh, I don't feel comfortable being recognized because what if I live so long?" It's the intent.
Sure.
It's the intent of that contribution. So from that perspective, we obviously any organization is going to be so appreciative of whatever that is. But when it comes to sort of these types of charitable gift annuities and charitable remainder trusts, we don't see those as much.
Yeah.
And I don't know if it's, it's one of those things that's just not on people's radar. And so it doesn't come up. And if people aren't sitting down and doing a real strategic, thoughtful planning on whether this is something that's right for them, I definitely always will encourage the donors to sit down and talk to their financial advisor, because it might be, in a certain situations, it might be the right option.
Sure. And sometimes I think it's just a little more complicated and people don't understand how they work, and maybe that's just not something they want to
and
try to tackle.
Yeah, exactly.
So any last thoughts before we kind of just summarize what we have talked about today?
Yeah, I mean, I think the common theme, right, obviously is planning and being thoughtful, but I think the timeliness of this conversation in relation to the the new tax laws, and I would say charitable giving in general, I think, percentages are up. Every time there's a report about Americans being charitable, they're always more charitable than they were before. Research is being done on millennial giving. Millennials are giving at higher rates, and they're making larger gifts younger, and they're planning, they're doing their wills, they're doing all that thing at younger ages than previous generations. All of those things combined, I think, make it really important for people to think about how they're giving rather than that they just do. I think in the past it was more driven. I mean, it's all driven by emotion and desire to make a difference, but people would sort of give here and there. And I think now when you think about how much farther consolidating your giving in a particular way can go to benefit the organization, and then if there are vehicles set up and established to assist the donor and having incentives to do that, I think it's a win-win, but you have to be thoughtful. You have to start ahead. And I think more so now than ever, we're having these conversations, and we're having them with people who are younger and younger.
And I definitely see a trend with clients as well to maybe narrow down the number of organizations that they're giving to and making those gifts more impactful. So whereas they may have said in the past, I have 25 to 30 organizations that I give to and they're smaller amounts, I'm narrowing that number down to 5 or 10, and they're going to be more meaningful gifts.
Exactly. And as you mentioned earlier, that idea of sort of lumping maybe 2 years of giving together, thinking about what are those charities that you're supporting, and sort of focusing maybe this group of years, we're going to make a larger gift to this in this area, and to these other organizations later, rather than spacing that out.
Yeah, exactly. So as we kind of tie things up here today, what we've talked about and want to leave you with is, number one, proactive planning is even more critical today in today's changing tax environment, and it's really important to evaluate not only the potential donation amounts that you want to give, but what properties, what investment vehicles, not only cash, that you're using that will provide the most optimal financial benefit. There are a lot of strategies out there that are available, but they might not be the best ones for you. So working with your professionals, professional partners, not only your financial planner, but your tax professional, as a team to develop the best strategy for you in your individual circumstances is the best strategy. And, also work with the organizations that you want to give to, and, personalize your gifts and have a strategy there. Just like with Jana at Wayne State, make sure it's a gift that's the most meaningful gift for you. Personalize it. And again, if you have questions for either of us, or you have questions for your planner and how to incorporate any of these strategies into your plan, please reach out and we'll make sure that we get back to you. And please watch our website for upcoming events. We have a investment update event coming up in early February, and we hope to see you there. And with that, we will sign off and hope to see you soon. Thanks so much for joining us.
Thank you.